Hey everybody, Sean from Rest to Live here. And today we are going to be talking about Snowflake and really digging into the numbers, their most recent investor presentation. We also want to give you a quick state of the data warehousing, data lake world, what I see working in this space, and just provide some overall perspective on how things are going, how to read these numbers, and really just give an understanding of, what should we be looking for when we're looking at these kind of tech companies that have really cutting edge technology that maybe aren't always clear to everyone who's looking at it. So let's start off right here. This investor presentation I'll be going over today is from December. This is their Q3 earnings. And as of right now, today is January 20th. The current price of SNOW, S-N-O-W, which is their symbol, is $292.36. It's up 3.47% today. It's got a current market cap. This is a big one, 88 billion. And we've seen a 52 range from 184.71 up to 405. So I just want to set some metrics here as far as, where we are in the process. We're sort of at a middle road from a price perspective. So we're going to also see that a lot of analysts are going to be a little bit cautious here about what they're calling, what they think, almost irrespective of what the numbers are. This is why I like to combine an understanding of stock metrics, market caps, competitors, etc., but also think about it in terms of where an analyst might fall, what kind of growth they see, but then compare that to the real numbers from the real results that were just released here. So I just want to also call out here that we do have some recent analyst research done on this company. I am 100% not an analyst. I am not a financial advisor. I'm not giving you financial advice. I work in this space. I understand technology and analytics at scale, and I also have a really deep understanding of finance, alternative investments, and the way that I go to market in that space as well. But I am not a financial advisor. I'm not giving financial advice. This is merely my opinion and education on how to read an investor deck. So with that being said, we've got an average price target in SNOW of about $388.87, which represents about a 33% upside on the current price of Snowflake. We see a low of 310 and a high of about 470. So just to give you some perspective, the high represents quite a bit of an uplift. And even the low, funny enough, still represents an upside of even 6% where it is today. So at the time of making this video, we've had a couple of real tough days in the tech sector where we've seen prices really contract a bit. Today, the day is bouncing a bit, so it's hard to tell where this is going to end up by the end of the week. But the most recent analyst recommendation, which is actually from January 19th, so literally yesterday, is calling for a price target of 450. So I just want to share those numbers because I think it's important to understand that when we think about pricing, we think about where this thing could be. We're looking at the numbers as they were and trying to project out where they could be. And oftentimes when we look at an analyst number, it's 12 months in the future, right? So if you see someone thinks it should be over 4, it's under 3 right now. This doesn't mean in the next week the price is going to go up. It's really important as investors. We understand that. We're not talking about trading stock here. We're talking about, looking at this as an investment, as a company, as a business. So really good call out there that I want to make sure is really clear. I'm about to share my screen and go through this deck. First thing I want to say, thanks for watching. It seems like the feedback from these videos of going deep into the data, deep into the decks has been really, really positive. And someone requested Snowflake as one that I do. So I just figured, hey, why not? I've got some time at lunch today. Let's jump in. So I'm going to share my screen here. Excuse me, and sorry for the coughing here today. Okay, and what I want to do is actually properly share this. So it should be up in just a moment here. So I want to start off by saying with total clarity, I am not in any way affiliated with Snowflake. I'm not a representative of Snowflake. I do not work for Snowflake. I have no current investment in Snowflake, perhaps in one of like a total market index or something like that, but I do not own a Snowflake stock straight up, and I do not have any options in Snowflake. So just want to be totally clear there so you know that. So what this is this is the actual investor presentation that was given by their executives on the most recent call, which was in December 1st, if I recall correctly. And this is for the third quarter fiscal 2022. I'm excited about Snowflake. I've been hearing about Snowflake for a long time. I'm very familiar with the company and what they're doing, and I'm going to speak to that in a moment. And as always, right, their presentation is including all kinds of ramifications around their finances, the way they're reporting it, et cetera. Always keep in mind that this is meant only for education from the way I'm presenting it. There's zero recommendations coming out of this. So here's the thesis for Snowflake. For many, many, many years in the tech space and the data world in general, The way you would buy storage is you would have to buy an entire server, right? You'd have to have racks somewhere with some storage space. Sometimes it's in the basement of a building. Sometimes you have to rent a building. Sometimes you have to pay someone else to rent a building, whatever the case is. The easiest way to think about this is if you were going to go to a self-storage facility, because you've got some stuff you want to store for a little while, you go and you buy a small locker. And then after a while, the locker's not big enough, you've got more stuff. So now you have to go and move all that stuff into a bigger locker. Then over time, maybe that is not enough, so you got to go and move it to a bigger locker. It's a lot of work. There's a lot of things to consider. The prices are very hard to determine into the future. You don't know if you're going to need more storage, less storage, so you always have to almost err on the side of caution. This is what it's been like to work with data over the past 60, 70 years. There's been lots of creative ways of doing it. The cost of data has certainly gone down, but the key issue was having to actually find space to store all of these actual pieces of hardware, these towers, these server towers. They're big. I'm 6'2", 6'3"-ish. They're taller than me, right? So like those are big servers, probably actually the same width as me as well. And when we think about it, there was a need. There was a need to create a way of looking at consumption, of being on the cloud. But the issue we were seeing in the marketplace was many of the core providers, the Oracles, the IBMs, many other these older companies that were in the storage space, they had that on-prem model, that premise-based model where you would physically be buying servers and racks to store the servers, right? And all of the hardware that goes with that, all of the wiring and electricity that goes with it. And as new technologies were really bursting out onto the scene, this model became just completely inflexible. There's no elasticity. It was very hard to have to think about how many servers or racks you need to buy and how much space it's going to take and how you're going to pay for that, rent it, insure it, protect it, etc. And this idea of a cloud native architecture came to be, where folks like Snowflake and others as well started thinking, what if we just essentially represent that storage facility, but we do the moving for them? We can open up that box even more. We can raise its roof. We can push the sides out so that when you need more storage, no problem at all. We just simply push those walls out. You've got more storage. Storage is shrinking. That's okay. Close it up. You pay for what you need. And that's really the most basic version of what cloud native architecture means. It was built on the cloud, for the cloud, with elasticity in mind, so that as your consumption needs go up, your storage for data goes up, you just add more, you provision more space. That's it. It's that simple. And this is really great from a company perspective because it creates long-term growth for companies like a Snowflake. It creates opportunities for companies to think and scale efficiently, effectively, with a high degree of efficacy, because they can afford to buy only what they need when they need it. I'm going to get into some really interesting points as well that if you're not in this industry, you would never really know these things. It's going to come up later as I go through this. But there's a lot of reasons why this model really works. It's not a traditional SaaS model in that sense, that there's other components here and other ways to think about it. So as you can see on the screen, right, this idea of cloud native architecture goes back quite a bit, right? We go back to 2014 as they have on here, and we were thinking about how do we get a cloud data warehouse, that basic idea of that storage facility. Then it became, how do we do a cloud data platform? So we can start to do more with it. We can look at the workloads that they need, how to expand it easily, how to perform more action on top of it. Then we come up with this real key piece, right? This modern day version, which is what they're calling the data cloud for content vector and network effects. Essentially, this is where we now have the ability to scale cheaply within these companies to the size of the data we need. We can leverage public, non-private shared spaces. We can look at how we can add services on top of that. We're going to get into that as we go here today. And it's Snowflake's belief in mind as well that, a cloud native architecture, as we just saw, is a required feature for any modern business, because we know that there's lots of things we need to pay attention to. How much data is coming in, how well we're working with that data. Think about how fast it's moving, how fast you can analyze it, how fast you can find it, how fast can I talk about it. But it also has to have a utility model where it can change as you need it to change, right? And I mentioned this on the previous screen, but this instant elasticity is really important, because if I suddenly have a new product coming to market and I expect to double the amount of space I need for my product, I can easily double my space like that. It's that simple, right? That's the idea. We're going to get into this as well from a contract perspective, how this creates opportunities for Snowflake that I think a lot of investors may not always understand. In the market as it is today, this could create some opportunities in my mind as well. And then ease of use. I want to be clear here. You own a company. You develop software, gaming, products, whatever. It doesn't matter to me, right? But you collect a lot of data. You want to store that data, combine it with other data sources, do analytics on the data, and derive insights from the data. That's ease of use. Ease of use, in my mind, is how easily can Snowflake go out and touch other databases, other transactional systems, other points of interest where you're storing data, right? You might have your financial data in one place, your customer data in another place, your sales and marketing data in a CRM. This allows everything to be combined into one location. You can standardize it and then run your analytics on it to get those insights. That's the idea of ease of use. How easy can we go and grab those different pieces? This is sort of an eyesore if you're new to this, but I want to talk about it quickly. This idea of centralized storage from Snowflake's architecture perspective is that they have a central location. This is theoretical, of course, right? Where all this data is theoretically stored. They don't care what cloud you're leveraging to move things around. That's where that cloud agnostic piece comes in. And once we have that centralized storage, we start to think about how we add computing power above and beyond that, right? How do we layer in the power on top of that data? And then the fun stuff gets in, right? The cloud services. How do you secure your data? Know who's accessing it? How do you pull metadata away from the data? Metadata is data about data. I know it's deep stuff, and I don't want to go too deep on the technical piece of this, but if you're new to investing or you're experienced in investing and you don't know these things about the companies you're in, it's a big miss. Because if you can't look at this chart and compare it to IBM's version of this, Oracle's version of this, whoever, right? You can sometimes miss key things that are really important from the standpoint of what you're investing and how you're looking at your investments. So again, these cloud services, right? How do we optimize for movement, for structuring, for how we table things? How do we think about optimization in and around accessing the data, doing analytics on it? How do we control that management perspective of it as well? Because it's a cloud native data source, we can think about, do we want to pull all the data somewhere? Do we want to push it somewhere else? Do we just want to have a window or a real-time sync or query of our data? So the ability to not have to go and pull all that data into a different system, but bits and pieces, have a live feed, just have a window into that data and take a snapshot of it. Things that maybe as an investor or as a trader, maybe you don't care about, but I will tell you first and foremost, I'm an investor first and a tech person second. This is how I think about my level of investments when I think and I compare and I plan my long-term moves. I need to understand the technology and the impact it has. So again, their platform in a nutshell is really great here, right? They're sitting in the middle of a whole bunch of things. They've got data sources coming from all over the place. This is what I was talking about, that ability to connect to different sources. They've got consumers on the other end, right? Leveraging those services. How do we monetize data, create operational reporting, do ad hoc analysis, that ability to really drill down multiple layers. And then, of course, real-time analytics. Think about things like IoT data, where you need to understand in real time how, how a jet engine is running, for example, because you can't have errors there. Underneath their platform, you see that cloud agnostic approach, whether it's Google Cloud, AWS, things like S3, Redshift, et cetera, or Azure, all of that's fine. And then up top here, you see sort of those platform services. I know this might be overkill, but it's important to understand how these things work, because otherwise, how do you compare it to another competitor and know if this is a good play versus someone else? Now, here's the good stuff. Here's where I'm actually excited to start talking, because this is what I love to look at. When I think about the business I'm about to invest in, right, as both an angel investor, a public sector investor, and then just a general of my retirement accounts, what I want to understand is, what is the actual market look like for data warehousing? And I'm including data lakes in here as well. So the data warehouse market, as it stands, is about a $14 billion business, right? And it's shrinking, because more and more people are going to this cloud data platform. And it's the belief of Snowflake that that market looks like about a $90 billion platform. Now, once we think about that that hardware within data warehousing, that agnostic platform around cloud data, the big, big opportunity in the future is going to be just the massive data clouds that exist, because every single business out there, every consumer, every time you swipe a card, every time you buy something, every time you eat something, every time a company produces something, tons of data is being produced, boatloads of data is being produced. That needs to go somewhere. And that's why this market is not shrinking. There's going to be new players. I don't know if they'll overtake Snowflake or not, or how they're going to be at the end of the day. But here's the stone cold reality. Data is not going anywhere. It's getting much, much, much bigger. And the major players in this space are going to reap the rewards from it. This was their slide, of course. I'm not going to speak to everything on here, but clearly they work with some major names in their space. I recognize quite literally almost every single name on here. And here's some highlights they threw in, and I think these are important things to touch on. Right, what we want to see is how they're growing, right? This is my number one thing I look at a company, is how they're growing, how their customers are growing, the types of customers they're engaging with, and the size of those deals. as well as are there any things that are standing up and not looking right to me? So I'm going to call it out like it says on the screen, right? Rapid growth, 110% year over year product revenue growth. Obviously amazing. Significant expansion with existing customers. This is a big deal. I'm going to double down on this. In the world of software, SaaS, cloud services, anything where we have a consumption model, the ability to have net revenue retention is massive. I actually almost can't even stress this enough. If you take one thing away from this whole call, 173% net revenue retention means that their current customers, not new customers coming in, not new money from customers who aren't currently customers, right? Customers who are already customers, sorry to be so specific, but customers who are already on board are growing with them significantly. And the beauty of this is the cost of acquiring new customers is so much more than growing your current customers. So what this means is customers are signing on board with Snowflake. Whatever they like or think about the services, they end up with much bigger, more consumption, more growth. That's a really good sign. And 173% is an amazing number. I just want to throw it out there. That is significant, frankly. Now, we see here as well, we've got strong, large customer momentum. So in a nutshell, what they're saying here is 148 customers as of the time of this presentation are doing over $1 million in revenue with their products. So that's a good number. We want to see that number grow though, right? So when Q4 results come out in a couple of months, what I'm looking for is definitely going to be, is that 148 significantly increased or not? And if it's not, I want to see the other numbers and see what that net revenue retention looks like. And as well, this is going to be a non-GAAP product gross margin. I'm not getting into the weeds here. You can Google these terms, but a gross margin of 74+%, that's pretty darn good. That means they're making a lot of money on what they're selling. This is standard for the style of business. I don't want you to think this is unheard of. It's not. But it just speaks to the point that there is typically really good ability to reinvest in the business, to create more marketing, to really create more go-to-market, to generate more business across these other previous pieces here on the screen. I thought this was interesting that they called this out. They're not a SaaS model. So SaaS is software as a service. So the easiest way to think about this is I own a business with 10 employees, and I need 10 licenses of a CRM system to store my customer data and have my 10 people log in and see it. I pay on a yearly basis, and then I renew and pay for a yearly basis, and I renew and pay for a yearly basis, right? And it's pretty standard. If I had 10 more users, I buy 10 more licenses. I can negotiate terms and contracts, but the reality is, that's pretty much a software as a service, right? I buy as I go, or I buy maybe some demand, but overall, it's pretty standard. These are some pretty cool things they called out here. And but what I do want to call it too is, I think a lot of people in the data warehouse cloud native space could say these things too. So I don't want you to look at this and think like, wow, no one else is doing this. I think depending on how you structure the numbers and how other competitors might talk about this, they could say the same things, right? But what is interesting is 93% of their revenue is completely consumption-based. And again, they have a little caveat here that was for the 3 months ending October 31st, 2021. Revenue recognized only as consumption occurs. I'm going to speak to this on another screen. In many cases, rollover unused capacity is permitted, generally the purchase of additional capacity. So I want you to think about this. I think I need 1,000 square foot storage space. Turns out I really only needed 800 square feet. What they're going to let me do is carry that extra 200 without paying more for it into my next year, and allow that when I also add more on in general, right? So I'm going to be able to keep what I don't use and add it to my new contract. Some other key things here too, right? Contract durations are increasing along with larger customer commitments. In the world of SaaS, data storage, consumption models, long-term commitments of contracts are a big deal, right? Everyone wants to get 3-year and 5-year deals. Typically, the customers make out really well on the discounting and what they get in the terms. And from a Snowflake perspective, it's a big deal because they get to commit to long-term agreements, lock pricing in, and have predictable income. And as an investor, that's what I'm looking at, right? If I go and look at Starbucks, I want to know how many cups of coffee are going out that door a day, right? And be able to start to create a per store value. That's a retail business. With these businesses, it's almost the same thing. They need to understand its scale, and as an investor, I need to understand its scale. What does that long-term obligation look like? What will they be paid into future terms and periods? And of course, a lot of times those contracts can easily be restructured and grown as well. So keep that in mind. And then the final piece here, which again, I don't think this is anything that anyone else can't say as well, but they bill annually in advance with some on-demand and arrears work. standard stuff, nothing crazy here. I don't want to go over too much and put everyone to sleep here, but like, here's a couple of things that they really point out that they focus on. I'm just going to move my little face here. Product revenue and RPO. This was interesting. I hadn't really looked at it in these terms before, but here's why we as investors should care about this and track this, by the way, right? I don't care that they're telling me to care about it. I care that I want to track this on an ongoing basis to understand the insights being delivered to me. So why does product revenue matter? Per their own words here, right? It's a substantial majority of their revenue, as we just saw. Customers have flexibility in how and when they consume. This is really interesting. I love the way they broke this down. They have contracted capacity consumed, including excess in period and rollover from prior periods, okay? On-demand capacity consumed as well. So as they need more, they can grab more and consume what they have. But what's great here from the numbers for me is contracted customers who have yet to consume are not counting towards revenue as I'm reading this. If I'm wrong, this is education only, so don't hold it against me and do your own research. Of course, this should be your layer one research, but that's how I'm reading it, right? When we think about product revenue, what this is saying is if a customer signs up and pays, but hasn't used the product, they're not yet counting that towards consumption. A lot of times in this world, what we call this is forecast versus actuals. I'm forecasting customers going to spend $1 million, but what if they only end up spending $200K, right? This creates concern on the back end, the contract renewals, et cetera. So just keep that in mind. And then they separate from product revenue, remaining performance obligations or RPO. These are contracted future revenue that's not yet recognized. Very similar to what we said a minute ago, but also think out years, right? We're not going to start to count them until they start to kick off. So this means that they're looking at deferred revenue here. They're looking at committed unbilled backlogs. Backlogs are huge in this space. But what they're not looking at is on-demand arrangements and certain time and material contracts billed in arrears. So let's take a pause here for a second. Earlier, I said I was going to talk about special circumstances. So there are lots of companies out there who have the need for expanded or special terms and contracts. This can mean different things at Snowflake, but I want to give you a general sense of what this means. I need to go out and buy storage for my company. I make, widgets that I sell on a website. I know, however, that during the Christmas season, my needs for storage space might 30x, okay? I might want to have something written into a contract where I can access that level immediately for a pre-approved price, but maybe it doesn't kick in unless some certain term happens. So you can be creative in how you think about this, but essentially what they're saying is there could be specific arrangements within the contracts that don't necessarily happen or don't happen under certain circumstances. So that's why they're not including that in there. That's my take on it, and that's my take from experience in this space, but could always be different. I'm just going to skip past billings because I don't, not too concerned there. Oh boy, my face is suddenly blocking my view here. So we've got a strong combination of scale and growth, right? According to this chart here, we're looking from an FY20 to an FY21 on product revenue of 124% year-on-year growth. Wow, that's insane. That is a huge amount of growth and actually starts to paint the image of why analysts are predicting that the price is likely to grow. It's a predictable model with known customer base, good contracts. And I mean, look, let's be serious here, right? Going from 265 to 592, that's pretty darn great. And as we even look at quarterly revenue, we see 110% year-over-year growth with consistent uplift from quarter to quarter here. I want to call out too, this is interesting. The dark line here is professional services and other revenue. So professional services is implementation, service integrations, sort of like I buy my Snowflake consumption, right? I buy my access to the cloud. Professional services is like actually standing it up, hiring a consultant, things like that. So I think that's actually like getting things turned on, up and running, working, integrated, connected, et cetera. Not every customer probably does that. There are consultants who are outside of Snowflake who most likely do this as well. So their ecosystem of partners are going to be taking over some of that too. This is another one that's pretty interesting too, right? Significant customer commitments. These are remaining performance obligations. So earlier we talked about this idea of actuals versus forecasts, or what's in the pipeline or backlogs, or we even talked about not counting revenues until they happen. So essentially what we're looking here is the amount of contracted future revenue that's not yet been recognized, right? So the way they define this, and you can see it down the bottom of my screen. If you're on a phone, I'm going to read it because it's probably hard to see. But what these things represent is the amount of contracted future revenue that has not yet been recognized, including deferred revenue and non-cancelable contracted amounts that will be invoiced and recognized as revenue in future periods. RPO, as we saw earlier, excludes performance obligations from on-demand arrangements and certain time and materials contracts that are billed in arrears. Let me give you a breakdown of what this means. You and I are conducting business. we agree to a $200,000 deal. We're going to do 50,000 of that deal today. We're going to sign a contract. We're going to do another 150,000 of the 200 in 6 months. But we're committing to that. It's a signed contract. It's an obligation. You cannot cancel it, or you still will owe me the money. The reason why a customer would do this is they might know for sure that they need the full 200K contract, but for the first 6 months, they're standing things up and getting up and running. They really only need that 50 to do that. So they can easily agree to like those future dated terms, those future dated orders, things like that. So they're still fully contracted. They're still fully agreed upon. They're still signed. They just don't have they're not paying you until that point hits. Otherwise, everything is the same there. So that's why this is a good thing to think about is even as we look out into these future years, like, man, look at that growth that already exists for performance obligations. That's pretty interesting. Large customer momentum, right? I'm not going to do the same thing and read everything on the screen, but you can see it's pretty obvious, right? Total customers are growing 52% year over year. Customers with over $1 million in product revenue have 128% year over year growth. That's really great. I mean, credit to Snowflake. They've got some great stuff in here. Now, this is an interesting one. I have not seen another presentation show something like this. This is really great. In fact, I now expect to see this from everyone that I follow. And I'm going to literally start emailing IR departments and ask them why I'm not seeing this. So when they think about how they land strategic customers, what they're defining as Fortune 500 customers, look at this growth, right? A 30% growth rate of growing that Fortune 500 customer base, where they were starting out here from 171, and look at this consistent growth up to 223. When you have 223 of the Fortune 500 as customers, I think it's safe to say you're doing at least something right here. Okay, we're almost at half of the Fortune 500 is now leveraging Snowflake to some degree. Now let's clear the air here because this isn't all excitement. It's very possible that a customer could have $1,000 contract and now they're signed with a Fortune 500 customer. So I'd want to understand more when I do extra due diligence here. Like, what does that spend actually look like? Do we have a breakdown of what the revenue looks like in this space? So keep that in mind. That's something that's really important to me as well. And then additionally, if a giant Fortune 500 company acquires a bunch of companies who happen to have Snowflake, well, then by default, I guess in theory, you're now a customer as well. So it'd be interesting to see how they break that up. And I don't expect them to deliver that during an IR presentation. Their retention rates are absolutely insane. I almost can't even believe this as I'm looking at it. So their net revenue retention, as we explained earlier, are current customers who stay as customers and grow their spend. This is a major indicator that I use in my research, in my due diligence, when I think about tech stocks and anyone who has a cloud-based, SaaS-based, consumption-based model. Very, very important net revenue retention rate. Because I'm going to go a little bit deeper here again on this idea of churn and attrition, because it's really important you hear this, because you need to know this to invest in these companies and understand what's happening. One of the biggest issues that every modern company has is stopping the bucket from dripping, right? That drip represents customers who are leaving you, spending less with you, attriting to different businesses or different products. Now, the way you do this is you focus on which customers are likely to churn or attrit and do everything you can to save those customers. And on the flip side, what you try to look at is how do I replace that spend? So this means marketing costs, sales costs, having to go out and acquire new customers, new contracts. A lot of effort goes into that, a lot of time, a lot of cost. With net revenue retention rates like this creates somewhat of a moat from the perspective of that high gross margin rate combined with an increasing customer base of preset customers. So this creates a lot of flexibility. This creates a lot of ability to go to market very aggressively. This is a really great chart as well. When you're looking at this, it looks pretty flat. Maybe it's not exciting to see it. These are really good numbers. Big focus on improving product gross margins, right? We already talked about this a little bit earlier, but what they're looking to do is see further, how do they expand more of their product functionality, more of the things they can do, right? So just simple things like changing cloud agreement pricing. How do they scale across more enterprises? I would assume this is what they mean here. And then a bigger focus on enterprise customer success. Customer success is a really big deal. After you become a customer of a technology company, typically you have a customer service rep or customer success rep. They help to ensure that you are being onboarded or brought into the technology successfully. So there's a little bit of hand-holding perhaps, there's a little bit of explaining how to do things. Maybe there's free training, maybe there's some directive training. That's what that means, is really scaling up the way they work with customers and ensure they're successful. Enterprise customer success is really a multiplier that once you get that customer on board, they have a great experience becoming a real customer who pays, and then they tend to stay on the platform if they're treated well. So again, something to watch in future releases here. I don't want to go too much in here as well, but again, they're talking about operating leverage while investing in growth, right? How do they spend money the right way to get more leverage from an operations perspective? So you can see here, like free cash flow as a percent of revenue into the positives here. They're looking at economies of scale, large customer relationships. We've already covered all this, and a bigger renewal mix leading to lower commissions. Now, salespeople should be very upset when they see this, but I get why it makes so much sense, right? So the more they can focus on renewals, the less it's being counted as a net new sale and having to pay, multiple people commissions on that sale, which eats into the margin. This is a really good one as well. I haven't seen a lot of other focus on this from some of the presentations I've read through the past couple of days, but I mentioned this during my Palantir breakdown the other day. Hiring in the tech space is a major issue. I would almost argue it's becoming a backlog and a major sticking point for a lot of companies to succeed right now. I'm not going to focus on the charts and graphs here. I'll let you look at this while I speak to it, but there are only so many really, really great sales folks, customer success folks, executives, managers, leaders, data scientists, analysts, right? Name the position. And as more and more companies grow and more startups are kicked off, the competition and cost to get the best performers is getting tougher. Now, it's easy to argue that you don't need all A players. A good mix of maybe a couple of A's, some good B and C players is a great mix for a company. But to really perform at scale, ensuring you not only have a strong bench of performers, but you've got a pipeline of potential hires that you can get if you lose people is really important. So I don't want to get into the numbers here because they're sort of not relevant to the way I look at this. I'm just looking at the tech issue in general of how do we start to produce more people who can do these jobs, more people who have an understanding of the technology and go to markets around it. So calling that out, that is a big problem in the tech space right now. And everybody's growing, everybody's trying to hire. And the cost of hiring, the cost of acquiring new employees is going up. The expectations for benefits are higher. And as they should be, frankly, that's supply and demand. It's about time hiring gets what they want. So just keep that in mind too as you're looking at all this. I'm not going to have a big focus here. Clearly, they do a huge majority of their business in the Americas. They're pushing into EMEA. They're also pushing into Asia Pacific and Japan. And you can see it's sort of staying about the same, right? Small growth. And that growth is a lot when you think about the revenue numbers. But again, nothing surprising here. They'll slowly grow overseas as we go. This is also helped by that net revenue retention rate. This is also helped by acquisitions. So I think you're going to see some good stuff here. But again, this is one of those things I'm looking for is what is their TAM or the total addressable market? And then how does that get expanded by focusing outside of the US and North America, South America, et cetera. So they provided some guidance here. I don't even want to get into this because I'm not going to read through every financial line item. But if you want to do this, it's no problem to find these things. It's very simple to read an IR report or any kind of earnings reports they have. But long story short, look, right, we're looking at some numbers here. Some are good, some are bad. Do your own due diligence on this piece. There's an appendix. I'm not going to get into it. I just want to share like what an appendix looks like. This is the real numbers, the real things you want to focus on. And then finally, let me wrap up here. This is all as of October 31st, 2022. This is specifically from them. This is a great one-pager. And normally I don't share these in these, but I thought this one was done so well, I wanted to share it. Make sure you're reading the bottom here as well. If you have any questions on these or concerns, feel free to pause the screen and read it. But in a nutshell, right, as of October 31st, 2021, which is their Q3 FY22, product revenue is at $312.5 million, 110% year-over-year growth. Net revenue retention rate is 173%. We have total customers of just over 5,400, which look at that, right? 52% year-over-year growth. Wow, that's crazy. $148 million plus customers, 223 Fortune 500 customers. They have 924 data marketplace listings, right? And then also from a customer satisfaction piece, which really matters a lot here, but probably feeds a lot into that net revenue retention as well, is they believe that there's a 612% customer ROI delivered over 3 years. I mean, that's pretty darn compelling. Again, what I want to say though is you have to have comparables in the marketplace. Is Snowflake coming in at 612 amazing? Sure. But what if everyone else is at 1,000? So you got to really run these numbers. Not everyone is putting these out so clear. And that's part of the issue of why you need to read through these and understand the data and do comparative analysis as well as you go through it. They have a net promoter score of a 6. They're calling it specifically a 68, probably to show that it's closer to a 7. NPS scores are really important. They're very similar to like customer satisfaction scores. A net promoter score is essentially saying customers are likely to promote your brand versus be against your brand. It's really specific, right? A 68, as they say here, not bad, not great either. But to be totally fair, in my experience, a lot of happy customers are not doing surveys and NPS surveys, etc. So I think people with bad experiences are more attuned to give surveys. So I sometimes take these with a grain of salt. It's important from an indicator perspective. Like I'd like to see in the next report that it's up from 68, but the number's a little bit irrelevant for me as an investor. I'm looking at the other core real numbers, the finance, the math, the growth. Those are the things that are going to drive me. And then finally, right, their customer satisfaction score. Wow, I mean, 100%. Like I don't know what to say about that. So with all of that, I'm going to stop sharing. I hope you watched till the end of the video. I hope you got something out of this. The sun's starting to come in on my face here. The bottom line is this is an exciting company with wild growth, okay? And that is a great time to think about doing your due diligence and looking into if this company makes sense for you. And then also looking at how you do comparative analysis against other similar companies of a similar size and a similar industry and segment that go after the similar customers. Because if they're growing this much, and they're taking more and more of the Fortune 500, and their net retention rates are really great, and the customer satisfaction is good. Well, we're assuming that these aren't all startups that didn't have any services the other day. What we have to assume is they're coming from someone else. So my big question is, who's losing these customers, right? Maybe this is a great example for me to take a long short style position here. Maybe I think there's huge growth in Snowflake, so I want to look at things like options or leaps, right? Maybe it's just something I want to hold in my portfolio. Or conversely, maybe I think these numbers are unsustainable, so I want to build a strategy around that. I'm not recommending you do any of those things, but what I am recommending is when you think about your own portfolio, how you analyze a company, I think it's extremely important and frankly, just really smart. You got to look at this level of detail and decide what kind of commitment you feel, what your strength in this customer is going to, into this company is going to be, And then again, like look at what the analysts are calling out, but read their reports. Understand why are they calling this out? What is it about it that they think can see a huge price increase? So with that, I hope this was useful. If you found value, I would really appreciate a subscribe and a like. It really helps the channel out. I want to be able to do this more, and that's one great way to do it is just getting more exposure on it. And then additionally, please leave a comment. If there's other companies that are really interesting to you, let me know. And to be totally clear, it could be anything. It doesn't have to be tech, analytics, doesn't have to be finance. It can be from manufacturing to consumer goods to health and life sciences. Doesn't matter to me. Like the numbers are the numbers, and I can provide perspective on them from my purview as well. So with that, thanks so much. Hope you have a great day. Hope you enjoyed watching this, and let me know what you think. Thanks, everybody.